Here again, this isn't just about safeguarding your assets, it's about proactively building a foundation that enables your life dreams and goals to take place no matter what's going on in the world around you. Because if you don't, you could end up missing on life's important opportunities that typically take place only once in a blue moon. Making a generational impact starts with one person, one family, one community. And so the Gen 1 legacy is my attempt to help first-gen tech professionals like you get your financial house in order so you can live your legacy. Have you ever missed out on an opportunity because you didn't have enough cash on hand to make it happen? I know I have. And for me, it happened when I was trying to buy a new home with my wife after relocating across the country, but our money was tied up in an investment property. Now, this situation took place nearly a decade ago when our family relocated from the Bay Area to St. Louis. But imagine yourself in our situation. We had just moved thousands of miles with 2 little babies in tow, with most of our belongings now in storage, and all we wanted to do was find a place that we could call home. Now, at the time, there were 4 of us cramped up in a tiny 2-bedroom apartment because we wanted to take the time to scope out the right neighborhood to buy our perfect new home. Well, needless to say, we were all biting at the bit to get settled into our final destination. And so I decided to put up one of my rental units back in California up for sale so that I could raise the cash needed to fund our next purchase. And by the time we were ready to go house shopping, I was confident that my rental unit would sell quickly. That's because I'd already accepted an active offer on the property and closing appeared to be just weeks away. So then by this point, I felt confident enough to go out and do some home shopping without much concern about whether the timing was right. But the trouble was that I didn't actually have the cash in hand needed to actually complete the purchase transaction. But did that stop me? Well, of course not. I mean, I felt so confident that we'd close on our sale that we even got to the point of finding our dream home, sitting down with our real estate agent and starting the process of writing an offer on this seemingly perfect home. Now, there and then I could have written an earnest money check and signed that offer. But I knew that I was taking a big risk because the sale on the property back in California was still pending. Well, fortunately for me, my good senses kicked in and we decided to pass on this purchase. Now, it was disappointing for sure, but fortunately for me and my family, we avoided a huge pitfall because my rental sale fell through just days later, and from there, it actually ended up taking another 2 months to complete the sale of the property. So then the big lesson for me here was how being illiquid or dealing with the lack of access to cash can delay or even derail some of our best laid plans. Now, have you ever found yourself in a similar situation? Have you ever gone to make a big ticket purchase knowing you have assets to fund it, but have found yourself facing a cash shortfall? Well, here's the thing. You may have a lot of wealth stored up in real estate or your equity comp, a business venture, or even your retirement savings. But even as a high earner, missed opportunities, or worse yet, Murphy's Law, can often strike unexpectedly and catch you flat-footed. That's why it's essential to focus on developing a cash management strategy that allows you to maintain a robust liquid cash reserve so you have access to money when you need it. Because without this financial buffer, you might be compelled to sell investments at the worst possible time, risk feeling financially insecure, and could even face delays in achieving your personal life goals. Now, you've likely heard how nearly half of Americans can't afford a $1,000 emergency bill. And so you can appreciate how essential it is to have an emergency savings fund established. With that said, however, it's quite likely that your situation has changed over time and an emergency fund may not cut it anymore. That's because as your income grows and you accumulate more assets, you have a greater ability to handle typical financial setbacks. So then your ability to deal with a $100 or $1,000 issue that would otherwise call for what we consider a traditional emergency savings fund typically wanes as you make more money, right? That's because given your higher earnings, you can typically fund such emergencies through your regular cash flows, right? And so why would you need an emergency savings fund? Well, the thing is that some individuals believe that leaving cash sitting idly by in a savings account when it could be used in a more seemingly productive pursuit is an unappealing proposition. And while this position might be true to a certain extent, one of the biggest issues I've observed working with individuals who've come into a lot of money over a short period of time is often their lack of appreciation for not having an adequate cash management strategy. And so what is a cash management strategy? Well, what might appear to be an emergency fund from the outside, a cash management strategy often goes above and beyond addressing the unique risks that an emergency fund might otherwise cover. How so? Well, it comes down to the kinds of risks that we're trying to mitigate here. You see, for the average American family, an emergency fund can help stave off insolvency risks that can come from the sudden loss of a job, paying for medical emergencies, or handling a large tax bill. In other words, without this pool of money, a family could easily face the prospect of bankruptcy if they don't have the necessary assets to sell or if they don't have necessary cash in the bank. Now, for families of means who've accumulated significant assets, insolvency may be less of a risk. That's because in similar situations, you might already already have the assets available to sell, like those in your brokerage account, real estate investments, or retirement savings that you could tap into in a worst case scenario to keep you solvent, right? But here, the risks are different. While you have access to these same resources, a key risk that you're likely to face now if you don't have something similar to an emergency fund, or in this case, a cash management strategy, is that you could face liquidity risk. And so how is liquidity risk different from insolvency risk? Well, while solvency risk is the risk of going bankrupt because you don't have the assets necessary to service your debt or other immediate financial needs, liquidity risk is more about selling assets at a fire sale price to address your immediate cash need. And now this cash need could include dealing with situations like a sudden medical or tax bill when most of your money is tied up in assets that take time to sell, such as real estate or stocks. Sure, you could borrow against your real estate holdings, but that could take weeks or months. And this issue gets even more complicated when an emergency does come up and you need to pay for these big expenses right away, but nearly all of your liquid assets are tied up in the stock market. That's because if the market is trading down when you need to sell your stocks, then you could find yourself selling your holdings at a loss just so you can have access to that cash. That's liquidity risk. It's the risk that you won't be able to access your money quickly, or you risk losing some of its value when an urgent need arises. So then if you're employed in a volatile industry like the tech industry, then the sorts of liquidity risks tied to these events becomes even more salient. For example, in the tech industry, there are external factors like market downturns, corporate restructurings, and rapid changes in the technology itself that can significantly impact your financial stability when these risks rise. How so? Well, many of these companies are heavily invested in growth and innovation, which is typical of high beta, high risk stocks. So then these stocks are often sensitive to market downturns, which can lead to a quick devaluation of your portfolio's value if you have much of your wealth tied up in your employer stock. In other words, if a large portion of your wealth is tied up in your company's equity, either through company stock options or vested RSUs, then a market downturn can rapidly lead to a decline in your net worth at the worst possible time. And this situation becomes especially challenging if you need to access cash during a downturn because you could be forced to sell assets at a loss to cover your cash flow needs. Let's take a look at the situation a little more closely so I can show you what I mean here. Now imagine that your employer has issued you stock options for all the good work that you've done. And these stock options that were issued just vested, so you're at a point where you're ready to exercise, right? Now, can you imagine that feeling? Up till now, you've been patiently waiting for this moment because it means that you're likely to come into a big cash windfall. In fact, it's a moment where you're likely filled with a sense of optimism because you're not just participating in your company's success, you're investing in what you believe will be a brighter future for yourself and your family, right? And so as you exercise your options, you choose to hold on to some of the shares so you can reap the benefits of long-term capital gains. Now, you're not worried about paying taxes right now because you want every share possible to be rising with the broader market, right? And so on the surface, this may seem like a solid strategy, and that's let the stock ride and reap in the gains when you need the money. But the truth is that this approach is not that cut and dry. That's because almost out of nowhere, the market could shift, and your company's stock, which at first seemed like a sure thing, could drop due to unexpected factors. Maybe it starts falling because of a disappointing earnings report, or a change in market regulation, or simply because a sudden change in market sentiment. And when the downturn does come, the decline is often sharp, and it could be enough to keep you up at night. But here's the real kicker. Remember that tax bill that was generated when you exercised your stock options? Well, the amount you owed to Uncle Sam hasn't changed because of what's going on in the market. In fact, it's stayed the same the whole time. So then here you are with a dilemma on your hands. The tax bill hasn't changed and is based on the high point of your shares, but your means to cover it just dropped significantly. So what do? Well, to make ends meet, you might have to sell far more shares than you've planned to cover your tax bill, and now you potentially have to sell them at a loss. Worse yet, you might even need to tap into other illiquid savings or investments that could further throw your financial goals into question. Either way, this situation really drives home how critical it is to have a cash management strategy in place, especially if you work in a volatile sector like tech. You see, cash management isn't just about emergencies, it's about freedom. Now, we've covered the clear financial costs of not having a cash management strategy in place, and then finding yourself stuck when you don't have access to the liquidity when you need it. But there's also an emotional cost here as well. You see, like I mentioned earlier, my own experience with being illiquid was especially profound and disorienting because it was a hard lesson learned on my own without anyone guiding the way. And so as a first-generation wealth builder yourself, because you don't have the benefit of inherited financial wisdom or fallback resources, every financial hiccup sometimes feels like a potential disaster. That's why being liquid is not just about money, it's about the peace of mind and security that your money represents, right? So then the stress of potentially not being able to meet your obligations when you need to, or to take advantage of of opportunities that come your way doesn't just add tension to your life. In fact, at times, it can dominate your thoughts and leave you feeling trapped and powerless in your own journey to financial independence. And here's the thing. The emotional weight of these moments can ultimately become overwhelming to the point of paralysis, especially when the safety net that you think that you've built for so long seems so fragile. That's why when you do experience a near illiquid moment, that event won't just impact your financial decisions in that moment, it could also affect your overall well-being and potentially the money decisions you make from that point forward. That's why developing a solid cash management plan isn't just about prudent financial planning, it's also about taking a critical step in safeguarding your mental and emotional well-being. Indeed, this approach is about giving yourself the confidence to navigate both the peaks and the valleys of life with both financial and emotional resilience. You see, cash management isn't just about emergencies, it's about freedom. Now, the big lesson for me here, and likely for you as well, is how liquidity risk, or the lack of access to cash, can not only delay your best laid plans, it can derail them entirely. So then what can you do to ensure that you have a foundation in place for a solid cash management strategy? Well, your cash management strategy likely will be dependent on several factors like your sources of income, available cash and cash equivalent assets, your living expenses, and anticipated big ticket cash needs. With all that said, however, let me take you through a simple 3-step process I consider when it comes to preparing my own cash management process after I've accumulated enough assets to cover major emergencies. So then, first things first, what I typically do when developing my cash management strategy is to focus on preparing my essential cash cushion. Now, you can think of this as your financial safety net, and it's all about avoiding those uh-oh moments when the bills are due, but your cash is tied up elsewhere. I mean, you don't want to be caught off guard, right? So then, to accomplish this outcome, what I typically do is calculate what I spend every month on absolute necessities like my mortgage or utilities and groceries, and stash away enough cash to cover these expenses for the next 2 to 3 months. This is my go-to fund in a pinch. So then, if you want to evaluate your own cash cushion, you can start by asking yourself, what's my monthly must spend to keep my life running smoothly? In other words, how much do you really spend each month to keep the lights on? Here, it's crucial not to track each and every expense, because in an emergency, you'll hopefully cut back on dining or other expenses, right? So then take some time to look through your last few bank statements, evaluate your key expenses, and come up with a reasonable cash cushion figure. Then top up your bank savings to hold up about 2 to 3 months worth of cash on hand, and think of this as your personal financial shock absorber. Now, the next thing that I like to do is to prepare for the unexpected. And every once in a while, life has a way of throwing curveballs my way. It's those big, unexpected, and expensive curveballs. Whether it's a sudden home repair or a hefty tax bill, I want to be ready without having to disrupt my long-term savings plan. So then, besides my basic cash cushion, what I want to do is set aside a chunk of change for those larger, less predictable costs. Here, what I'm looking to do is to aim for 6 to 9 months of expenses and something a tad more accessible than my long-term investments, but still earning money for me while I'm waiting, like a CD or a treasury bond. Now, as you get started on gearing up your own cash management strategy, ask yourself this, what's the biggest financial surprise I could face this year, and how much would it likely cost? Then from there, map out potential big expenses like your tax bills, or if you work in a volatile industry, consider how much of a cash reserve you'd likely need to have on hand to weather a potential job loss. Either way, it's essential to start a separate savings allocation for this purpose and raise enough cash from your less liquid assets over time to give yourself another 6 to 9 months worth of cash flexibility. Finally, take the time to periodically tune up your cash management strategy. Now, I know my life isn't static, and I'm pretty sure yours isn't either. So neither should your cash management strategy be as well. That's why it's essential to carve out some time for regular tune-ups to ensure that your cash reserves are keeping pace with your life changes. So then every few months, take a step back and review your cash flow needs. Here, what I'll do is evaluate whether I'm over-prepared and missing out on investment opportunities, or whether I'm scraping the barrel too often and tapping into my less liquid cash equivalent reserves. And so one quick way to assess this outcome is to ask, do I have the cash I need when I need it without the hassle? And in situations like this, what I like to do is put in a recurring reminder in my calendar to review my financial situation at least quarterly. This way, I can adjust my cash buffers based on what's new in my life, whether that's a change in income or changes on the home front or other professional or personal things that are pulling on my wallet. And from there, then I can make the necessary adjustments to my cash management strategy. But when it comes down to it, the big question when it comes to cash management isn't just about being prepared for emergencies, it's about having cash available to take advantage of opportunities as they come up. Ultimately, it's about empowering yourself to thrive amidst the uncertainties. That's why I know when I'm prepared for whatever life may throw my way, I'm free to make decisions confidently and ultimately in a way that enhances my life. So then how about you? Why not take that first step right now? Why not take the time to assess your liquidity needs and begin crafting a cash management plan that reflects your own life situation? Here again, this isn't just about safeguarding your assets, it's about proactively building a foundation that enables your life dreams and goals to take place no matter what's going on in the world around you. Because if you don't, you could end up missing on life's important opportunities that typically take place only once in a blue moon. Think about that dream home that could slip through your fingers, a unique investment opportunity, or even a hefty tax bill that catches you off guard. These aren't just potential scenarios, they're real challenges that could disrupt not just your money, but your entire life path. But imagine a future where financial surprises don't derail your plans, but are merely speed bumps in the course of your life. Imagine a future where you're equipped to seize life-changing opportunities because you've already built a solid financial foundation. So then commit to starting your personalized cash management plan today. Because by doing so, you're not just planning for the unknown, you're actively creating a path to a life filled with success and peace of mind, and one that takes you one step closer to becoming the master of your own financial independence journey. To learn more about today's topic, you can visit the episodes page at legacygen1.com. And if you can find one person in your life who would benefit from today's message, please share this episode with them. But until next time, I'm Peter Donisanu, wishing you and yours abundant health and prosperity.
The Gen 1 Legacy Podcast is brought to you by Franklin Madison Private Wealth. Franklin Madison Private Wealth is a registered investment advisor firm with its registration and principal place of business in the Commonwealth of Pennsylvania. Registration of an investment advisor does not imply a certain level of skill or training. The information shared today is not intended to be personal, legal, investment, or tax advice, or solicitation to buy or sell any security or engage in a particular investment strategy. The commentary and forecasts are limited to the dissemination of and general information pertaining to Franklin Madison Private Wealth's investment advisory services and are based on economic and market conditions that are subject to change without notice. For additional information about Franklin Madison Private Wealth, including fees and services, please contact Franklin Madison Private Wealth or refer to the Investment Advisor Public Disclosures.